Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Right now joining us, Jordan Rochester with a wonderful set of overnight notes. He's with FICC Macro Strategy EMEA with Mizuho. Jordan, let's go a little wonkish here right now. As Cam Dawson was talking about this trust series, SOFR 10-year, I'm looking at it out 3 standard deviations. It's been worse over the last 4 days. Where's the trip point for these liquidity trust series for you where we get to market chaos?
I think that's the biggest question to ask. It was one of my key concerns earlier this week was about dollar funding because the whole world was facing such higher tariff rates for US. What you're going to see is that exporters to the US were no longer going to receive their dollar receipts, and then dollar funding would become an issue. The only good news that I can give you is that you just had a record Q1 imports in America. And so a lot of these exporters around the world will be sitting on a dollar cash pile that's a little bit more healthier than usual. Right. Now we've had this 90-day reprieve at 10% tariff rates. I do see the flows of commerce still taking place between Europe and the rest. But the problem is with China, with these extreme tariffs that we have, we've got a 145% tariff rate on China. It's one of the largest trading partners in the world with the US. And so you're going to see a dollar liquidity issue at some point unless we have a climb down.
Jordan Rochester with us from Mizuho. We welcome all of you on your commute this morning across the nation. It's Friday of Bloomberg Surveillance, very much market focused. We'll do a little bit of Washington, and certainly those announcements out of the White House will be key. John Tucker with us for Lisa Mateo in this hour. Damien Sassower in for Paul Sweeney with his wonderful emerging market focus at Bloomberg Intelligence. Damien, a question to Mr. Rochester.
Yes, Mr. Rochester, formerly FICC Macro at Nomura, now at Mizuho, so really in a great place to talk about China here. And look, everybody's blaming the 30-year move on the basis, on leverage selling or buying or whatever it is. But, I just got to ask you, I'm getting a lot of questions about China and what role it had in these treasury swings. I know not your colleagues, but your peers over at SMBC are basically saying that China was involved in that, and now Citigroup's getting on board. What are your thoughts there?
I could never say whether China was involved or not. We just don't have the data yet until at the end of the month and next month. That's the irritating thing about data. It's slow. But what we can say is that if you're a central bank and you're facing extreme currency pressures, it makes sense to be selling US Treasuries to defend your currency. It's been very smooth in dollar renminbi, and so that's kind of possibly been behind it, I would add.
So let me ask you this. Now that, the dollar's declining in the face of all this, very unusual, do you think Asian central banks have more scope to cut rates here?
I think the whole world does. This is going to be a huge growth shock to the US, but a big growth shock to the rest of the world. And what's going to happen is the Chinese exports that are no longer going to go to the US at the same rate. We'll be looking for the next consumer. Europe stands out to me, but parts of Asia too. We'll see excess supply of Chinese goods hit their markets, and that's going to lower the selling price.
Jordan Rochester, within all the research capabilities of your shop, do you people just look at the various supply chains and almost frankly the demand chains where China, beleaguered by the White House, runs their product through Vietnam, runs their product through Indonesia, runs their product through Kazakhstan?
Long term, that's probably what's going to happen. Short term, how quickly they can do it is difficult. For example, Chinese exporters were discussing in an FT article just over the past few days, they had set up in Jordan, which has a FTA, Jordan the country, not me, an FTA with the US. But Jordan, as a result, has a 20% tariff rate now under these the sort of expected levels of reciprocal. And so even countries with FTAs where China exporters had sort of hedged themselves by moving into countries to do the final production part there and sell on to the US, US, the plan's scuppered. If everybody has a 10% tariff rate,
Right.
it's really hard to do the rerouting. But for Chinese exports at 145%, sure, they will take 10% by rerouting, but it takes time, and it's not going to happen in the next few weeks.
I mean, Damien, we got to focus this down here because we have Damien Sassauer with us. The bottom line is Fusheng is making a lot of the golf heads for Callaway, Ping, and Titleist. Are they going to have to run that through Vietnam, Damien Sassauer, to help improve your lousy game?
I pay an awful lot for my Pro V1Xs, but here's what I have to ask Jordan. I mean, look, we know that the China dumping is on the rest of the world is going to happen. We know transshipments are going to happen. We know Europe's the clear winner, but here's my question. How will bilateral trade negotiations with the U.S. evolve? And here's what I'm thinking here. You have active discussions going on right now with India, Japan, South Korea. Are non-tariff variables going to play a role here? I mean, are they going to start talking about currency manipulation and start holding some of these Asian economies, to bear for that? I mean, how do you even begin to talk about that and regulate that?
I don't know about your experience with government officials, but it never goes quickly, does it? Whenever your life involves dealing with the government, it's quite difficult to get things via email chains over the line. So I am skeptical about how quickly you can get complete free trade agreements in the next 90 days. What I can think that a lot of these countries can do is buy themselves more time, extensions, waivers, more time to deliberate. The EU's offering 0 for 0 tariff rates, for example, but the US is claiming that non-tariff barriers are their issue. Non-tariff barriers requires regulation changes, requires votes in parliament. It's a bit more difficult to do than just simple tariff manipulation stories. And on the FX side, I do agree. Besant's made it clear several times, informally and formally, about Japan, for example, having too weak of an exchange rate and the Bank of Japan perhaps needing to hike rates more. So these will be a factor in the talks.
I got it. John Tucker's thinking long yen here to be a stronger yen. Can you model out, as you did the other day, Jordan Rochester, 145 yen down to 135, dare I say short term, given dollar malignancy that we get yen to a strong 130 yen per dollar?
Yeah, what's quite clear is we're having a de-dollarization theme play out in the market. The theme's gone from slow to rapid in the past 48 hours. A lot of that has been corporate demand as well. So that the market's been seeing, pushing up the likes of euro-dollar and dollar yen and the yen stronger. For the Japanese yen, I think that we could have another 5% devaluation in the dollar from here if we are truly pricing in the US exceptionalism come to an end. Once you have a 10% trade-weighted fall in the dollar, typically that's when it bottoms out and rebounds. So we're using the 2018, the COVID-19 playbooks, and we've got another 5% at least to go here. That gets dollar yen quite close to 135 and lower. That's the sort of view I have for where we get to over the next few months. And it was something I thought would happen next year. So it's all happening very quickly.
Jordan, thank you so much. Jordan Rochester with us with Mizuho.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
What does Kathy say at Schwab? Joining us now, Kathy Jones, to straighten out her fixed income portfolio. Do people buy the dip in bonds?
Yeah, I think you have to be careful, but I think that is probably a very good idea. The question is, are we at the yield level that's really attractive? In some parts of the market, I think we are. I think in municipal bonds, you're looking at, tax equivalent yields for a high earner in the 8-9% area. High credit quality, I think that's a place you start to nibble on.
Okay, but on the commercial break, John Tucker's over here with Robinhood day trading NVIDIA. He's buying the dip. When you buy the Kathy Jones dip, are you buying duration? Are you saying extending out your maturity? Are you what's the math of buying the fixed income dip?
Yeah, so right now we're still at benchmark, which is consistent with the Bloomberg Ag, and that's around 6 years. And we've been kind of hugging the benchmark for a long time because of all the uncertainty. We feel like you're still clipping a pretty good coupon of 4.5% upwards to 5% in high quality bonds. That's a good base. We're not extending duration yet. We have to wait and see how things play out. But I think that will be a move that we make probably sometime later this year. But high credit quality, we're really just focused on high credit quality and making sure we have enough liquidity, not going into instruments that are illiquid at this stage of the game, trying to play it safe. But I think the opportunities are starting to emerge.
Damien, is a dollar an illiquid instrument?
Well, Kathy, I have to agree with you. Munis, mortgages as well. I think, high quality mortgages. But, what really stands out in this move, guess what asset class woke up within fixed income? Credit. And we saw spreads blow. And now I'm looking at IG and high yield, down 2.5%, 3%, just since the 2nd of April. What are your thoughts on credit markets going forward?
Yeah, we're still a little bit cautious, although, again, we're getting tempted. We have been kind of on the sidelines in credit for a while, just staying up in credit quality because the spreads were so tight, you didn't get paid for taking risk. But now, we're starting to get paid for taking risk. The problem is, I think, the mix of policies we have right now is so difficult to interpret or even come up with an investment thesis that you can carry through the end of the year because it could change in a heartbeat. That's where we're having trouble. But I do think if those spreads blow out some more, we will start looking at more credit.
We've also seen a massive steepening, dare I say, in U.S. yield curves, not just the U.S. really, global yield curves, And so, when Tom asks about positioning along the yield curve, I'm just curious, I'm hearing a lot of people saying they still want to be, along the short end of the curve, as opposed to the long end. I'm just curious to hear your thoughts there.
Yeah, I think that thesis makes sense because we are anticipating rate cuts down the road. And if this continues, I don't see how the Fed holds off because we'll see higher unemployment on the horizon. But I don't want to just hug the short end and miss out on grasping some of these yields for the long run because I do think we're going to get a slower economy. I do think the Fed will at some point have to lower rates, and I want to capture some of that.
All right, I want to report, Damien. Damien, stay there. Right now, the market moving, futures are up like 40, and they're now up 11. We actually had red on the screen for a bit. The Secretary of Treasury with Maria right now, maybe he can have the same effect as James Dimon a few days ago. Damien?
Kathy, U.S. Treasury demand in this, kind of downtick really took a bit of a knock. And, I'm just curious, we know we've been transitioning away from the Fed, from U.S. banks and foreigners. And, what does this mean, in your opinion, to term premium over time? I mean, are you thinking that this steepening of the curve is structural, that it's going to last for a long period?
That's a really good question.
I do think it's going to last. Okay. Term premium, we actually came into this year calling it the year of the term premium because we have to incorporate now these risks that are out there. And I do think we'll continue to see the term premium move up, not just here, but globally, but especially here because this is the source of uncertainty.
I got 20 more questions. We don't have time. Kathy Jones, you're a trooper to come in today. I can't imagine what the Kathy Jones calendar looks like at Charles Schwab today. Chief Fixed Income Strategist and Yield Curve Watcher at Charles Schwab.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Within the span of this week, this historic week, it is a good time to speak to Savita Subramanian. She is with the Bank of America, but far more than that, delivers Berkeley mathematics, philosophy, and massive deadhead knowledge, and joins us this morning here. She was definitive in making ESG adult. For all of you that were screaming, stop the peace, love, and dope, just give me the math. Savita Subramanian led the charge to a constructive ESG debate more than a few years ago. We're thrilled she could join us in studio. Wonderful to have you here. I love what you do in your Bank of America report, which, unlike most ego-driven strategists, you actually listen to your securities research. You actually pay attention to what's going on in the trenches. Lorraine Hutchinson has a worse job at Bank of America. She's got to figure out what Walmart's going to do with China.
I know.
What does China do to the consumer, and how does that fold into your world?
Well, I mean, Lorraine has been spot on in calling out that a lot of these companies with exposure to China actually started shifting sourcing out of China into other regions of Asia, as well as Mexico, other parts of the globe, as early as, 2015, even before any of the tariff talk began. So, I think that the idea that these companies are vulnerable to China alone is not necessarily the case anymore. But closet China via, Vietnam, Mexico, that's what worried us about the initial April 2nd announcement.
A few years ago, you were in high school. I got a phone call in Singapore, go over to Bank of America. So I walk in, it's me and Ken Lewis having a conversation about Bank of America in Asia. You guys have a heritage there. You have a history there, really like no one else. So what's China do here? Damien's going to say they de-dollarize. Do you just assume China solves the problem without unilateral negotiations with the White House? Bilateral, I should say.
That's TBD. I think that where we are now is where corporates have to really think about how they're going to plan. And that's the problem, is that it's hard to plan when you just don't know what the playing field looks like. What I think is interesting, though, is that there's been this knee-jerk reaction to buy Treasury bonds instead of stocks as a safe haven. And I think that's exactly wrong. Because if you look back on what happened in prior periods of protectionism, prior periods of stagflation, whatever we're heading into, value stocks outperformed Treasury bonds by a massive margin. The last thing you want to be stuck in during a stagflationary environment is long duration bonds. They have no options. Whereas stocks, to me, are the best place to be in an environment where you need those options. Companies can extend or shorten their duration. We saw this with Meta and Google in 2023. They both initiated dividends and transitioned from being just pure growth to value. I think this is a really interesting time to think about value equities, companies that are returning capital like utilities, even metals and mining, even, energy companies where the dividends are sacrosanct. I think those are areas that you really want to think about.
Savita, I'd like to ask you whether you prefer Terrapin Station or American Beauty, but we're not going to ask that. It's earnings season. It's a great time to be alive. And,
yes.
I don't think it's going to be, the earnings at all that moves markets. It's going to be the words, the forward guidance around it. What are you expecting here?
Absolutely. And I think what's a little bit worrisome is that we have a lot of companies shutting down guidance and going dark. And that's never really good because
like the worst.
I think one of the reasons that we were bullish on U.S. stocks is that they're the most transparent equity market in the world. All of these companies issue guidance, and now if they stop, that's one more nick in the America, exceptionalism story. I think, what do we do with that information vacuum? I mean, what I think is interesting is that companies are already thinking about how to navigate this period, and it could be something like recasting your costs as IP, or thinking about how to shift sourcing more creatively, how to pass that price along to consumers. And a lot of companies have the option to increase prices as long as wages remain relatively healthy.
With the Bank of America, Savita Subramanian with us. We welcome all of you, your commute across Bank of America's nation, and of course on YouTube, and particularly good evening in the Pacific Rim. YouTube, subscribe to Bloomberg Podcast. As CPI yesterday, I got negative statistics for that business inflation, PPI. I'm not going to go into it other than to say it does show a disinflationary tendency, pretty much everything said. Futures go from up 20 to up 26. The VIX comes in actually 41.45. Let me say that Bloomberg surveillance and all of our economics is brought to you by Commonwealth. Join over 2,000 independent financial advisors. They are taking control of their growth. With advisor-centric support and future-ready technologies, grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Damien?
Savita, put on your options hat for me. With all the uncertainty that's out there, implied vols have been all over the map. Surfaces are inverting, skews are steepening. What are your thoughts on buying and or underwriting equity protection here?
Yeah, I mean, I think that protection's already probably pretty well sought after. Yeah. I think there is actually potentially more upside than downside risk to the S&P 500. And I know I sound a little bit out of sync with everybody else here. But, again, I see this as a market environment where you want to follow the money. The money is not going into U.S. Treasury bonds. There's a buyer's strike on U.S. Treasury bonds. Where is the money going to go? I think it's going to go into inflation-protected income. Think about retirees. Retirees right now own this barbell.
Do I have to?
Well, let's think about what we all own. We own a barbell of cash and tech stocks, right? I mean, if you look at Merrill Lynch, our advisor data, 4 out of 5 of the top 10 holdings of retirees are tech companies. Right. Their yield is lower than the yield of the S&P 500. This is the first time in history that we've seen retirees not owning dividends.
Quickly on this, then is Apple a value stock, as you mentioned value before?
Well, I mean, it's certainly a lot more value now than it was a few months ago.
As Templeton would say, shares are on sale.
Yeah, I think that there is this notion that the dividends are relatively protected. Payout ratios are low for a lot of these companies. Right. That's what I would look at: is what's the payout ratio, what's their dividend growth profile, what's management's focus on dividends.
Your handlers didn't want you to do this interview because they know I'm going to get you in trouble. Okay, folks, here's the drill. Savita is so good at the spread market in math that she's one of the few equity people out there. What do we do with our 401k? That can go into the office this afternoon with Brian Moynihan, and you're going to explain to Brian, for the larger Bank of America world, the collapse 2.8 standard deviations off the log trend back to 2023 autumn of SOFR 10-year yield. And the answer is the underlining machinery of Mr. Moynihan, a guy building a building on Park Avenue, a few other people. The liquidity issue out there is really sport. How do you explain to bank management the tension going into this weekend?
Oh, I think bank management is well aware and on top of this. But I mean, I would say that, in environments like this, the trick is getting to the other side, and who knows this better.
Do you hedge that? How do you hedge the short-term trust market?
Well, I mean, I think that you look for areas that are short duration. Short duration is key in a liquidity crisis. And that means you go for cash, short duration bonds, stocks with high dividends, some credit, but not all credit. Credit markets might be healthier than they have been in prior crises. I mean, you tell me, Tom, but I think this crisis is so different from 2008.
Agreed, totally. Or 1998.
Or 98, or even the 70s, in that U.S. companies have completely delevered in terms of the larger ones, right? If you think about banks, energy companies, all the old economy companies that were hit in 2008 have become healthier, have really been preparing for this type of crisis. So I think that's the good news, is that within the equity market, you've got a lot of companies with solid balance sheets and, the ability to maintain dividends.
Savita, we're talking about retirees, and we're talking about retirement benefits here, and we're talking about Equitable Institute. Losses between the 4 trading days between April 3rd and April 8th, the 25 top state and local U.S. pensions lost almost $200 billion.
Well, yeah.
I mean, they're calling you. What are you telling them?
Do you know why that's happening? I think part of the reason is that everybody loaded up on private equity, private credit, and long bonds.
Interesting.
Which are hardest hit during any sort of cost of capital crisis. Think about all of these areas. They're going to be whacked by higher interest rates. And I think that's the problem, is that pension funds have supplanted all of their active public equity exposure with passive or private equity.
Interesting.
And that's why the S&P index itself is at risk. This is the most crowded ticker in the world. But nobody owns stocks anymore. They own the index.
But let me ask you this. I mean, aren't private credit funds allowed to mark their books like 4 times a year, call it once a year when they get the audit, right? So, I mean, it's not really showing up in you know what I mean? So,
not yet.
So that 4-day decline of $200 billion, that might not even be including the marks you're getting from private credit yet. So it could be much more is what you're saying.
Exactly. That's why I like equities. Again, they're marked to reality every millisecond of the day. And I think that's a very valuable characteristic as well.
Beautifully explained by you and Damien, better than I could do. Then where is the opportunity if passive is taken over? I mean, we get this from Eric Balchunas, but Savita Subramanian, give me an opportunity looking out past Labor Day.
Yeah. Buy the average stock in the S&P, buy the equal weighted S&P 500, buy large cap value, buy anything but the cap weighted index, because that's the area that I think has become bloated and potentially risky.
Can you buy Europe? I mean, let's be honest here, Damien. I mean, if I got Euro 113 to Savita Subramanian over at Louis Vuitton there on 57th Street and 5th Avenue loading up, I mean, is Europe an opportunity?
I think think Europe's an opportunity. I mean, I was more optimistic on Europe before the tariff wars began, because I think there's an opportunity for a lot of really interesting cross-border M&A where U.S. companies can buy cheaper growth in Europe than they can in the U.S. So, I think those are areas that could catalyze Europe. I think Europe also right now certainly looks a lot more attractive on a policy risk perspective. At least we know a little bit more about what's going to happen there. But I still think Europe's dependence on the U.S. and the interdependence between all of these regions is a risk that may not be factored in.
Call me if you talk to Brian Moynihan. We'd love to know what you're talking about. Savita Subramanian, thank you so much for attending.
Great to be here.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Jennifer Lee joins us now, senior economist. Jennifer, to what we heard from Damian Sassower, overwhelming awe is a presumption of a growth slowdown. Where will real GDP head?
Good morning, and thank you very much for having me on. Yes, well, right now it looks like GDP is headed lower in terms of growth. We're not looking for a recession in the U.S., but the risk of this continues to rise, just given, obviously, this escalating higher and higher tariff war. I'm losing track of all the percentages right now, but it looks like, we are maxed out at 145% on one side and 125% on the other side. So we'll see how this plays out. But this is, obviously not good news for U.S. consumers. You're going to be paying higher prices, even though, we brought all the other countries down to a baseline of 10% tariff. But, prices are heading higher, and this is what's going to hit the U.S. consumer, and this is what's going to cause the slowdown.
Are you going to a negative statistic on real GDP for this present quarter?
No, we are not. No, we're not. We're still looking for growth, but slower, much slower growth. And it's not just the consumer, by the way. It's also business investment. And, even though a lot of these, this invitation, we can say, to bring more investment into the U.S. is helping. We're seeing, lots of money coming in now in terms from different companies promising to build and to hire. But at the same time, it's just very hard to make any real strong with conviction investment decisions in this sort of uncertain environment. So I think that's also going to offset a lot of this incoming investment.
Jennifer, as you know, overnight, Beijing raised their tariff on the U.S. to 125%, but the accompanying statement stood out for me. They said, we're not going to raise anymore. You know why? Because it doesn't matter. We're not trading with them anymore. I mean, so in your models, are you modeling zero trade between China and the U.S. on a forward basis?
Well, it certainly looks like we are heading in that direction, but I can't see I just can't see how that is going to happen, just given how much reliance there is on both countries on each other for all this trade. So there's just going to have to be, they're going to have to start talking at some point. But right now, I'm very curious to see, number one, what the reaction from the White House is going to be, and number two, what other tools are going to be coming out of the toolbox, to borrow the language from monetary policymakers about what else can be used. If we are hitting that max of 145 and 125%, what's next? So we're going to start talking about export restrictions on rare earth minerals, for example, on perhaps treasury on the treasury holdings. I don't know what's next, but but if we're done with tariffs, there's probably a lot of other things that they can use.
Jennifer, many are referring to the 90-day window by Trump as him having blinked, right? I mean, he saw the devil and he basically blinked. And I'm just curious, if you're sitting there, you're in Beijing, you have to enter into negotiations, or for that matter, any country is entering.
Why do they have to negotiate?
Well, I mean, only if they want to keep trading with the U.S. Or you're right, maybe they just sit tight, sit on their hands, and let them blink back again. I mean, that's my question, Jennifer. How do you negotiate with the U.S. now that Trump has just put this 90-day window in? It does seem like he did blink.
It does. It looks like he saw the cliff. He goes, oh, there's the edge of the cliff. I'm going the other way. There are a lot of different interpretations of what happened. But, from one, I think all of us are very relieved that he did that. He did put in that 90-day pause, and I think that should be very much welcomed. And that was definitely a big step back from the brink, and I think that's what everyone should sort of focus on, and the fact that that is good news. Now, what's going to happen next? Again, that's anyone's guess, but I would really, really hope that both sides are going to start saying, okay, let's talk this out. Let's plan a summit of some sort in Beijing or in Washington, D.C., or somewhere neutral, wherever that's going to be now. and start hammering out what are we going to do to make all of this, to make both sides happy, because the global economy is really at stake here.
Jennifer, what's so important here is it's this oddity on a Friday of, wow, the American economy is great. Morgan Stanley out now has a return on average common equity of 17.4%. JP Morgan even better than that. We're moving from a 3% real GDP economy into some great mystery. Can the banks call Secretary Bessent and just say, stop this because of the liquidity issues, the bond issues, the dollar issue? Are you confident into the weekend that the big banks have the power to sway the secretary?
I would like to think that will be the case. However, I think the administration has bigger issues or bigger picture that they're focusing on. I mean, I believe President Trump did say that that we're going to be entering this this volatile period right now. Can't remember his exact words, but it's going to be some choppiness in terms of the economy, in terms of prices. So we have to, what they're trying to do is look through this and ultimately make this right this wrong. What they are saying in terms of global trade.
Jennifer, I got gold up $56, 3234. I've got SOFR 10-year, folks, which is sort of the heartbeat of the trust market, out 2.9 standard deviations off the trend back to the fall of last year. Aren't we at a point where the big banks, Diamond, Moynihan, the others, can call them up and just say, stop it?
Again, they can, but does he want to show that he is bending to, to corporate America? That's, the sort of like Fed Chair Powell, right? When he's on his cuts, people are going to be questioning, is he doing it because of political pressure, or is he doing it because he's trying to support the U.S. economy? There are going to be a lot of questions about this, and tough questions, of course, and they will be posed.
Jen, we've got to run here. Damien and I got to run, but this is too important. I got Looney 141 to a strong Canadian dollar 139. Can the next Prime Minister of Canada, whomever it is, can they stand a strong Canadian dollar?
I don't know if I would call it right now very strong. I mean, it's certainly better than what we had before. But I'm going to be curious. I mean, our election is April 28th. Whoever the new Prime Minister is going to be, whether or not there's going to be a majority government or not, what measures are they going to do to strengthen the Canadian economy? And that will be, that's the next focus.
Thank you so much for being with us today. Jennifer Lee, huge value add with BMO Capital Markets.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Erica Grosjean came out of Harvard and out of University of Wisconsin-Madison and did the thing that's wonderful in research. She wrote up research, I believe it was at the New York Fed years ago, and Damien, it jumped out of the page, jumped out of the screen. It was like, who is this person? And I interviewed Eric Grosjean. She was so young, I don't think she could drive. She's joining us now after a stellar career of public service as Commissioner of the United States Bureau of Labor Statistics. When you see DOJ say, we're going to move them out the door, no one has been in the crosshairs like Dr. Grosjean. Erica, thank you so much for joining us. It could be a 4-hour conversation, but we're going to be quick today. Erica, what is the damage to the people that do our economic data, built in 1947, best in the world? How does the labor statistics, how does CEA and the others, how do they move forward?
Wow. Now that is a big question. And let me start off by saying, I think up to this point, most of the damage has been collateral damage, hasn't been aimed at BLS or most of the other statistical agencies, with some exceptions in particular. But it's profound. It's lack. Right now, we're worried about, very worried about the loss of expertise. And at BLS in particular, that's going to be exacerbated in the next couple of weeks when the Department of Labor announces the reductions in force that it's intending to do. Will we be
able, Dr. Grosjean, to execute the 2 jobs reports in the first week of the month? or is that going to become a challenge to actually understand the American labor economy?
In the short run, probably not too much disruption, but the damage will grow over time. And we have also, what we're doing is getting rid of the necessary sort of option value that BLS has always built into its operations, so that when there's a weather event or some other problem, the agency can still put out the jobs report on time. That's going to be harder. And then finally, we are absolutely devastating the agency's ability to modernize in the way that it should.
Dr. Groshin, Larry Fink of BlackRock on the tape right now saying the sweeping U.S. tariff announcements went way beyond anything I could have ever imagined in my 49 years in finance. You had Jamie Dimon on earlier saying pretty much the same thing. What does this mean for the labor markets here in the U.S.? Can we expect layoffs ahead?
Wow. So one of the things that's characteristic of most recessions is that actually companies stop hiring before they start laying off. And so the place to look for the most immediate damage is just freezing of hiring. And we've already begun to see that in the fact that temporary help services employment has been falling.
Erica, we got
because that's often companies will stop hiring temps or fire their temps before they.
Erica, I gotta get one more question in here. We got breaking news. We're gonna have to run, but let me get this in, folks. The headline, which we'll get to in a moment: the United States has told China to request a Xi-Trump call. That, according to CNN, and that moved the markets. We are red on the screen, and now we're up 23 on the Dow, fractionally up, I would say. But again, this is the headline by headline sequence we're seeing, a reason to stay with Bloomberg all through this Fractious Friday. I can't imagine where we're going to be at 3 p.m. this afternoon. Erica, they said you were coming on today, and I said, great, finally, I can ask someone qualified. Erica Groshin, if we get to a 5% unemployment rate somewhere out there, is a 5% unemployment rate in America now the same as a 5% unemployment rate in 1985 or 1965?
Wow. The simple answer is yes, that's part of what we expect from our federal statistics, that it's collected in the same way, it's asking the same questions, and so it is comparable. That said, the economy has changed.
Right.
So when we look overall at who's unemployed and who's not unemployed and who's counted as working and things like that, there are changes over time. So right now, one of the things I would say is that we've just come off a period of historically low unemployment rates. So 5% wouldn't have seemed that bad, 2 or 3 decades ago, but now it's a significant increase in the amount of unemployment.
Erica, for all of us at Bloomberg, with great respect, led by our Michael McKee, thank you to you and our public servants in our economic data collection. Can't say how we rely on you each and every day. She is at Cornell University, their acclaimed industrial and labor program. Erica Groshin, always with the Bureau of Labor Statistics.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.